Today I'm going to show you how you can get all the money back for every single car you ever buy, drive, and own. I say this all the time, but I'm going to show you my personal example. But the question I always get is, Chris, can you get all the money back for every car you buy, drive, and own, even if you overpay for it? That is what we're going to talk about today. In 2024, I bought a 2020 Mercedes G63, the G-Wagon, but this one was special and this one was way overpriced. Did I get all my money back? Well, let's dive in. So let's look at this vehicle. Yes, I way overpaid for it. Matter of fact, in January of 2024, I paid $170,011 for a 2020 Mercedes G63. The truck was sweet. It was all blacked out, red interior, but anyway, who cares about what the vehicle was? How did I get all the money back is probably what you're asking. And you know what? That is what I would be asking. So right here, I took a loan from my policies. Now, when I say policies, some of you are like, what are you talking about? Specially designed and engineered whole life insurance policies is what I'm talking about. I call that my private banking system because that's what we're going to talk about. We're going to talk about how I became my own banker and how you can do the exact same thing I did with whatever car you want. But my loan that I had to take from my policies, I had a simple interest rate of roughly about 6%. Now it was a little less than that, but then it went up and then it went down during the period of time from 2024 to 2026 when I sold it. So I just went high on the simple interest. Your loan interest rate will differ from mine. This is just my story. I set up a loan repayment. In other words, so when I took the loan from my policies, the insurance company charged me about 6% interest, simple interest, which is very important. Now, what I did, when I was buying this vehicle from the dealership, I asked them, what is the best rate I could get on a loan? So their finance manager went out there and found the cheapest loan from a traditional bank, and you know what it came in at? So 7.4% was the interest rate. Now, what I had to do is figure out how long do I want to borrow this money for, and what is my monthly payment? Now, most people, when they buy a vehicle, they look at the monthly payment. They want the lowest monthly payment. Now, go online and look at what used G63s cost. They're going to be between $2,000 and $3,000 a month. So my target was right here, $2,931.28. So what I did is I set up a loan amortization for my private banking system. Remember, I borrowed my own money at 6%. Now, this is where people kind of get triggered and they're like, why would I pay to use my own money? Well, I'm going to show you. So don't get your panties in a ruffle just yet. I'm going to walk you through this because yes, the insurance company did charge me roughly 6% interest. I did set up a loan repayment back to my banking system, i.e. the whole life policies, at a rate of 7.4. So some of you might be asking, well, why did you do 7.4? Why didn't you just do 6%? Because the way I look at this is, if I or any of you would have went to the bank and you found the lowest interest rate in the nation for borrowing money for this vehicle, if it was 7.4%, why would I pay myself back any less than I would pay the banks back? The banks like Bank of America, Ally Bank, Wells Fargo, they're all traditional banks and they would gladly issue me the loan, but I wanted to pay myself back at the exact same interest rate that they would have charged me. And that was 7.4%. So let's look at the economics of this deal. Over 6 years, because that was the duration I was going to borrow the money for, and that's what the bank would have lent it to me for, the total amount of interest that I would have paid somebody else's bank would have been $41,041.42. Or you would pay $211,052.42 for this 2020 Mercedes G63, which I bought for $170,011, which was already overpriced. But this is what you all need to understand. When you finance a car, lease a car, however you buy it, all options except for you paying cash, which we'll cover that, you would have done this and you would have been thrilled. You want the vehicle. You found the lowest interest rate, which in 2024, 7.4 was a low interest rate, and you would have been thrilled. and you would have started making those payments, this is how much interest you would have paid to their bank. This is how much over 6 years you would have paid for that vehicle. You don't even think about that. So the dynamics and the economics of this is because I was the banker. This is how much I would pay back to my banking system. This is, if I kept the vehicle for the whole time, how much I would have paid for that vehicle, but I would have gotten that money. Remember, the only variable in this whole thing is the interest rate that I'm paying to the insurance company to use my own capital. Now, I know some of you are hung up on that, but we're going to look at it. Before we do that, so let's dive into the math. This is an amortization schedule on a 7.4% interest rate, 72-month car loan, okay? That's all I did. And you can see, in the first year, the interest on that would be $11,798.51. And $23,376.90 would be what would go back to principal, or that would be the equity in your truck, hypothetically. That's how much you're paying the loan down if your payment was $29,3128, right? So you can look at every year. I'm not going to go through them all. You know, you see the interest goes down over time and the principal goes up. That's how they work. You pay the bank the majority of the interest up front because they want to get their money. And you know what? If I'm going to think as if I am the bank, I kind of want all the interest up front too. So here's how it worked. I took a loan from my policies, not just one policy. I took it from many of my policies. This was a big loan. And the policies charged me roughly about 6% simple interest. But let's just think about that, right? If I had financed it through the bank, they would have charged me 7.4. Therefore, I structured the loan to my private banking system at exactly the same as the lowest bank rate would be, 7.4. So if the insurance company is charging me 6, and I'm charging myself 7.4%, am I not making a spread just like the bank? Now, some of you might not understand that, but here's how banks make money. You walk into a bank, you deposit money into the bank, okay? The bank may or may not pay you interest on that money, right? So just in your mind, I want you to think, how much are you making on the interest within your bank? Let's just say it's 3% for all intents and purposes. It may differ. It probably does. 3%. If you walked into that exact same bank and you wanted to take a loan, the bank will charge you more than 3%. That's just how they work. And you don't even think anything of it, but let that sink in. So if this was the bank loan, if the bank paid you 3 and charged you 7.4, is the bank not making a spread? They are. Now, if the insurance company charges me 6 and I pay exactly the same amount I would have to the bank, 7.4, am I not making a spread? Absolutely. 6 minus 7.4 is 1.4%. I'm making a spread. I'm doing what the bank is doing, and you should be doing this too. But you're still hung up on, why would I pay interest to use my own money? Let me just cover this real quick. Let's just assume you did pay cash for this truck. You overpaid for the truck, just like I did. I'm just flipping the role here. But you had the cash in the bank, and you're like, that Chris Naugle guy, I would never pay to use my own cash. So you take $170,000 out of your bank, and you pay cash for the truck, and you think you won because you got no monthly payments. And then you take and you do whatever you want with that, and you pay the truck down. You lost an opportunity. You lost an opportunity for $170,000 and change to earn some form of interest, even on a guaranteed basis in the bank. That money is no longer working for you. And what did you do? You bought a truck that depreciated, which is exactly where we're going next. I typically don't keep vehicles for long enough. I kept this truck for 25 months. I just sold it. And maybe you had done the same thing, but you see there's a big difference. If you paid cash for the vehicle, $170, and you sold that vehicle just like I just did in 25 months for $130,250. You, my friend, would have lost a ton of money. But you thought you won the game because you're like, I'm not paying interest on my own money. I'm going to take my money out and pay cash for the car. You lost. I didn't. Let me show you how. This policy loan that I took from my life insurance policies, my specially designed whole life policies, I only had that money out of my policies for 25 months because, like I just said, I sold the truck. I just sold the truck. I just didn't want it anymore. I can't explain it. I just didn't want the vehicle anymore. I was done with it. It was my third G-Wagon, and I'm done. The ship has sailed. The policy loan costs for 25 months at 6% simple interest are $21,251.38. That is what we call, in the infinite banking concept world, your cost of capital. But there are some economics of this deal that you must become familiar with. And for all you naysayers, I'm going to prove you wrong mathematically. Here are the economics. I bought the G-Wagon on January 2024. I paid $170,011. I just recently sold the G-Wagon right around February 6th of 2026, roughly 25 months later. And I sold that G-Wagon for $130,250, which was a pretty darn good price for it. Maybe not the highest, but definitely not what the dealerships were offering me, which was $125,000. So if we just did the math that way, and that would be how you do it if you paid cash, you lost $39,761. That's how most people would have bought this G-Wagon. You see, I didn't. I bought it using my private banking system, and I made money. I made actually quite a bit of money. I was quite surprised this morning when I was penciling all this thing out, saying, how much did I actually make? I was surprised, and I think you're going to be in a second. But again, we got to kind of run through the numbers on how I did this. Right over here, I paid $170,011. I made payments back to my policies. We call that recycle and recapture. I'll show you how that works in a second. But I recycled and recaptured the same payments I would have made to the traditional bank. Remember that $2,900 and change payment? Yep. Over 25 months of principal and interest payments, that works out to be $73,285 that I paid back to my policies. So that means that the amount owed on that vehicle is $96,729. That would be the balance, right? That's how much I paid. That's how much payments I made. That was my balance left. And that wouldn't be the case if you financed it through the bank, because you wouldn't be able to count all of that $2,900 and change monthly payment. You'd only be able to count the principal. Real quick, let's just look at that again. You see, here's that amortization schedule one more time. If this was you financing it through a bank, you would only get to take this off of the payment. So how much would that be? Well, let's see, 5, 6, 7, 8. We'll call it 48,000 and change, okay? That you would be able to take off. So 170 minus 48, you guys can do the math. It's not penciling. But you see, because this was my banking system, I didn't give up interest. And you know what? That's the most important thing that R. Nelson Nash talks about in Becoming Your Own Banker. He talks about financing and the cost of financing. You're either losing interest, okay, which is what you would do if you took the money out of the bank to buy it cash, or you're paying interest, which would be if you financed it through a bank. But when you are the bank, you make payments just like you would to the bank, but you get to keep the interest and the principal. So no matter what, I'm winning the game. Now let's go back over and look at what we just talked about. Right here, that is how I only owed $96,729 because all the principal and interest went against what I paid for the truck, which I overpaid for it. I admit it. But let's keep going with the numbers. Here's what I sold it for, okay? I sold it for $130,250. I owed $96,729 back to my policies right here. So technically, this would be what I made. But see, you're all thinking, no, Chris, that's not what you made. Don't forget, you had to pay interest on your own money. That dirty, greedy insurance company charged you interest at 6%. Duh, did you forget? Nope. But before we do that, let me just ask a favor, because this is going to get really fun. I need you to do me a solid. So just click that subscribe button. You know, I just hit 100,000 subs and I need to get higher, and I need you to do me a solid. And also right above, there is a bell that I need you to smash. Been studying Bruce Lee. That's pretty good, huh? Smash that bell so that you're notified every time I put out new content. All right, back to the numbers. $33,521 was my gross profit. The amount I sold it for minus the amount left after all the payments I made. Then I had to pay the insurance company that 6% interest. Now I do want to preface that this 6% may be different for your numbers. My numbers, this is just what I used. My interest rate with the policies all differ. So I did a blended weighted interest rate. So again, I'm just telling you your interest rate may be less, like 5.35, and it might be more, like 6.5. I'm just using a middle road. Don't hang me for showing 6%. That means that the $33,000 gross profit minus the interest that I paid to the insurance company means I still profited $12,270. But wait, you think we're done? You're actually psyched about that, right? You're like, holy crap. He freaking made money by overpaying for that G-Wagon. He still made money and everybody else would have lost money? But wait, there's one really important thing that we missed. Check this out. You see, inside these specially designed and engineered whole lives, I say this all the time, your cash value in a non-direct recognition company, which is what we use, your cash value continues to earn interest in dividends uninterrupted, even when you take the money from the policy. So, assuming a 5% internal rate of return on my policies, which I just went super low. It was more than that. My policies are very mature, but I just wanted to use 5%. You know how I got that? I called my buddy Caleb and I said, what kind of internal rate of return do you use when you show these policies? And he said anywhere between 3 and 5%. Because my policies are old and mature, I used 5%. So all we're doing is using a hypothetical, preface, hypothetical, disclaimer, your policies and your situation may differ than mine, so let us help you run the scenarios. And you can click the little link right up in the description. We are happy to run your scenario and show you your mathematics. You see, we got this awesome software called the Vault. You can check that out at BYOBvault.com. That would show you any mathematics behind the infinite banking concept and your own banking system. But let's get back into this. I'm assuming a 5% IRR on my money, $170,011. That's how much cash value I had to have. I had to have a little more than that to be able to take $170,000 out of my policies to buy this stupid G-Wagon. But that full cash value continued to earn interest and dividends on an uninterrupted compounding basis. Thank you, Albert Einstein, for talking about compound interest. Over 25 months, and if you do the math, just like I did, you could use ChatGPT, you can use a calculator, you can just do the wizardry in your mind. $18,174 in cash value growth. It would actually be a little bit more than that, but we used a different calculation just to kind of factor out a couple things. That's net cash value growth, okay? This is really important for you to understand because my money continued to earn. If you had bought this vehicle cash, your money was taken out of whatever place it was where it was earning interest. It no longer works for you anymore. $170,000 and change, no longer earning for you because you bought a vehicle cash and you thought you were doing it right. I'm sorry. This is just a better way. I was able to allow my money to continue working for me for the full period of time that I had this truck. For the full period of time, I enjoyed this truck. And because of that, using just a 5% hypothetical IRR on my policies, I would have made interest and dividends of roughly $18,174. Shut the frickin' front door. Maybe I'm more excited than you are. But here's the summary. So now you can get excited. The summary of my being my own bank on this G63 purchase, I profited $12,270. I just showed that. Rewind it, watch it, record it, save it, write it down, whatever it takes. Then my cash value continued to work for me for 25 months while it was out there working for me again in the truck, making a spread. So that was $18,000. I made roughly $30,444 on this policy, estimated net profit. And I say estimated and I say hypothetical because I think I actually made way more than 5%. And not only that, I used a higher interest rate for that simple interest that the insurance company charged me. You see, I stacked the cards against myself because I know not everybody's situation is going to be the same and I didn't want to show the best case. I showed the middle of the road case. I made $30,444 estimated net profit. I got to drive a pretty sweet truck. I think most of you anyway would agree that a G63 matte black, blacked out, red interior, bi-turbo, 600 horsepower truck is a pretty sweet truck to drive. I just outgrew it, or it outgrew me. I got rid of it, but it was fun. All right, we're in the final sprint here. I got to show you just how this whole thing works because it's really a visual. It's just a circle. And here's how it starts. You see, all I did to start is I changed one thing, and that was where my savings went first, not where it stayed. A lot of people redirect their savings and they put it into investments. They redirect their savings. They put them into high yield savings. That's fine. I changed my savings to go into specially designed and engineered whole life insurance policies from mutually owned life insurance companies that pay dividends. But stupid is what stupid does, and I just showed you the math of doing that. So I put it into my policies. Now, I found that truck. Yes, it was overcharged and whatever you want, but I took that loan. 6% roughly was about a little higher than what my loan interest rate was, and I deposited that money from my policies into the bank. How long did that take? Roughly 36 hours from the time I asked the insurance company for the loans. That's how long it took me to get the money. And it was deposited into my segregated bank account. So what do I mean by segregated account? It's just another bank account, and all I use that bank account for is my private banking activity, my infinite banking concepts activity. So it went in there. So now I got records of the money coming out of my policies and going into the bank. I then sent a wire to the dealership to buy this truck, $170,000. But you see, then what I did is I structured a note, okay? And this is important. I do this on every loan I take. I did a note from me, my private banking system, to myself for this vehicle, okay? And this vehicle actually was owned by one of my businesses. So my business is called BYOP. It stands for Bring Your Own Porsche. So Chris Naugle lent BYOP this money at a rate of 7.4% interest, which gave it a monthly payment of $29.31.28 a month over a 72-month loan, okay? That was the note, and this was physically done. I signed it by both parties, the lender and the borrower. The lender is Chris Naugle's private banking. The borrower, my company, BYOP. Now, I'm not gonna give you any tax advice. You can consult with your CPA, but just so you all know, there are some tax incentives to buying a G-Wagon because the suckers weigh over 6,000 pounds. You have probably seen this G-Wagon in, I don't know, no less than 10 of my YouTube videos. It was used for business expenses. It had stickers on it. It was used for marketing and advertising. So you can look up 179 bonus depreciation and you can see what I did, but that's another bonus that we're not even getting into. I then proceeded to have my company, BYOP, make payments of $29.31.28 every single month into this bank account, that segregated account. I then set up a loan repayment. I call this recycle and recapture. It's just a loan repayment form with the insurance carriers for $2,931.28. That money went back into my policy every single month. Now, there's a couple things that happened here. First off, the $170,000 never left my policies. It simply acted as collateral. The insurance company gave me a loan from their general account. They didn't even ask any questions. Well, actually, that's not true. They asked me 4 questions. What bank account do I want it going to? Is this a divorce decree? Is this, I don't know, there's like 4 simple questions. Boom, 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 done. Money was sent. But here's how they really did it. You see, all my policies have a death benefit of in the tens of millions, okay? So the insurance company said, hey, you know what, Chris? We will lend you the $170,011 from our general account because we got that money set aside for the day you die. Because you know what? We're all going the same place. Well, I hope we're all going the same place. I know where I'm going, and I hope you do, because I believe in God, Jesus Christ, all that good stuff. But nonetheless, I am going one place, and I hope you're going there too. And the insurance company knows that. So the insurance company says, and I'm just going to round down, if Chris Naugle has a death benefit of $10 million, sure, let's lend him $170,011 from his death benefit. So if I were to have died the day after I took the loan, they would have subtracted this $170 from that death benefit. That's how it works. But the insurance company does something really smart. They go in and they use my cash value, which was more than $170,000, clearly, and they collateralize this loan against my death benefit. So if Chris Naugle decides to lapse his policy, run off, they already know that Chris Naugle had enough cash value to pay this amount back to the insurance company. They love it. They charged me 6%. But here's the other thing too, and I already showed you the math. My money never stopped earning interest because my money never left the account. It never left the policy's cash value. It just simply sat there and continued to compound uninterrupted. While there's something else that happened. Every monthly payment I made of $29.31.28, that money went back into my policies as a loan repayment, which is kind of an interesting thing because every month that I made a payment on this G63, I had more money that I could use the next day because I'm the bank. So imagine if you owned a bank and you went in and you made a loan repayment to your bank. Your bank would have that much more money the next day when the check cleared, would it not? Are you understanding that? So every time I put this payment back in the policy, I have that money to use the next day. If you were to finance this vehicle with a traditional bank, every time you make a payment, that money leaves your family forever. And I'm sorry, I'm not cool with that. So I became my own bank, just like you should. But there's another thing that's happening. Remember, I took a loan for $170,011. You're sick of hearing that. But every month, $29,031.28 is being subtracted from the amount that I borrowed because I'm repaying it. But I lost no liquidity of the money. It's just calculating against it. So think of it this way. A monthly payment of $29,031.28 times, I did this for 25 months, okay? That's the interest that I paid. So that equals, over 25 months, $73,282. But every single month I did that, it was subtracting $29,031 from the balance. So let's just do the first year. The first year, I had paid down this $170 by the amount of my payments. The full amount, because the insurance company only asks me for the interest one time per year. So after the first year, let's just do this, 170,011. I'm just showing you how I do this. After the first year, I'm paying interest on only $134,835.64. So if that's the balance that I'm paying interest on, do you think that that works out to be less interest charged than it was in the first day? This is what being your own bank's all about. Every time I put this $29,031 back in my policies, not only do I have access to that $29,031, that $29,031 is paying down the loan to the insurance company. Because it's simple interest, it is called an APR. I am buying down the APR. You've heard banks talk about this, but you maybe never understood it. Well, when you're your own bank, you start to understand this. This is how I was able to do this. This is how I was able to profit. And I even showed you a lower profit than what I actually made because I had several factors that I didn't include into that, showing it worse than it actually really was. Folks, why don't you do this? Why doesn't everybody do this? Now, I get it. Not everybody can buy a G-Wagon, but what kind of car do you drive? I don't care what it is. How did you buy it? Did you lease it? Did you finance it? Or did you pay cash for it? And for a select few of you, did you steal that car? Did you get caught? Tell me how you didn't get caught. Anyway, don't steal cars. I'm just telling you that this way of buying your cars is far superior to any other way you can buy cars. And you know what? I just showed you the math. I just showed you my math. I made money on a vehicle that I overpaid. And the only reason I made money on this vehicle, the only reason it penciled like this was because I was able to be the bank. I was able to control the narrative. I was able to take all the numbers and not lose money, but I was able to make money because every payment went back to my banking system, not theirs. The interest and dividends that were paid on my cash value were paid because I got to earn interest and dividends on my money the entire time I owned this vehicle. This is the only place you can do that, folks. I hope you understand this. Listen, if you want to learn how to do this, you want us to model your loan, right up in the description, click that link. But also, I got another video I want you to see. Right here, I want you to check this video out. How to get paid to drive your dream vehicle. Thanks for joining me.